Governments love to tell you they are working to help you get out of debt. They talk about growth, stability, and opportunity. But if you look closely at history, you will find something far more disturbing. Governments have always used financial mechanisms to keep ordinary people poor while concentrating wealth and power at the top. And the most revealing truth is that these tricks are not new. They have been recycled for hundreds of years, sold under different names and dressed in different language, but they always serve the same purpose: move wealth upward and keep the majority dependent. The only thing that changes is the vocabulary. Today, you will discover exactly how governments throughout history have transferred wealth from the many to the few, why the same mechanisms that destroyed Roman savings are still draining your bank account today, and what you can do to protect yourself once you understand the pattern. Welcome back to Finance Insight in High Def, where we give insight into proven financial principles and how we can use them to improve our daily lives and build towards a better financial future. If you are new here, consider a like and subscribe as we dive into the 8 principles on why the money tricks governments have always used are still working on you right now. Principle 1. The inflation tax that steals without asking. The first principle is recognizing that inflation is not an economic accident. It is one of the oldest and most effective tools governments have ever used to transfer their spending costs onto the public without ever saying so directly. In the 3rd century, Roman emperors facing the cost of continuous warfare began systematically reducing the silver content of the denarius. A coin that was once nearly pure silver became mostly copper with a thin silver coating. The empire continued spending as though nothing had changed. But every citizen holding those coins paid the price through rising prices, disappearing savings, and wages that could not keep up. The mechanism is identical today. When modern governments spend more than they collect in taxes, central banks create money to cover the gap. That new money reduces the purchasing power of every dollar already in circulation. You do not receive a bill. There is no vote. The cost is simply embedded in higher prices at the grocery store, the gas station, and the housing market, while your wages fall further behind each year. Principle 2. The forced loan that dressed theft as duty. The second principle shows how governments have historically compelled citizens to fund state ambitions by framing financial extraction as a patriotic obligation. The trick is making people feel that surrendering their money is a matter of honor, not coercion. In medieval England, France, and Spain, monarchs routinely required wealthy merchants and trade guilds to lend money to the crown. These arrangements were not optional. Refusal carried the risk of fines, asset confiscation, or worse. The crown promised repayment with interest, but payments came late, arrived in devalued currency, or never came at all. During both World War I and World War II, governments sold war bonds on a massive scale, appealing to citizens' sense of national duty. People believed they were helping their country, and many were, but those bonds also became safe, profitable investments for wealthier buyers, funded by future tax revenue extracted from the broader population. The wars ended. The financial obligations lasted generations. Principle 3. The bond system that turned public debt into private profit. The third principle reveals how the creation of national banking systems formalized a transfer of wealth from the taxed majority to the lending minority that has continued uninterrupted for over 300 years. Britain did not create the Bank of England in 1694 out of financial generosity. The government needed capital to wage war against France. Wealthy investors purchased government bonds. In return, the Crown promised interest payments funded by tax revenue. The taxes that paid those interest obligations fell heavily on ordinary consumption, on salt, beer, cloth, and other daily necessities. The rich lent money to the government and received guaranteed returns. The poor paid taxes that funded those returns. Lending to governments became the safest investment available, and the labor and consumption of the masses guaranteed that safety. This arrangement did not end in the 17th century. It is the foundation of every sovereign bond market operating in the world today. Principle 4. The national debt that borrows from you to pay someone else. The fourth principle addresses how modern government borrowing presents itself as public investment, while delivering its primary benefits to bondholders, defense contractors, and financial institutions, rather than to the citizens it claims to serve. When governments spend beyond their tax revenue, they issue bonds purchased by banks, institutional investors, and foreign governments. Politicians explain this debt as investment in jobs, infrastructure, or social programs. A significant portion, however, flows to defense contractors, corporate subsidies, and financial sector bailouts. When repayment pressure arrives, governments do not cut from the top. They reduce social benefits, raise consumption taxes, or allow inflation to erode the debt's real value. The debt is presented as a public good. The interest payments flow to bondholders. The burden of repayment falls on taxpayers. The pattern has repeated across the United States, the United Kingdom, and virtually every heavily indebted government in modern history. Principle 5. The bailout that privatized gains and socialized losses. The fifth principle exposes the mechanism behind the financial crisis response that most clearly demonstrated how the benefits of risk flow to institutions while the costs flow to the public. In the years before 2008, major banks packaged bad mortgages into complex securities, collected fees on the transactions, and distributed the risk throughout the global financial system. When the system collapsed, the United States government deployed hundreds of billions in taxpayer-funded bailouts to prevent the largest institutions from failing. The argument presented to the public was that the entire economy depended on saving those banks. The banks survived. They grew larger and more concentrated than before. The executives who built the products that caused the crisis received bonuses in the years that followed. The ordinary families who lost homes and jobs received no equivalent intervention. The profits had been private, the losses were made public. This was not an emergency exception. It was a demonstration of how the system is designed to function under pressure. Principle 6. The pension promise that was never fully kept. The sixth principle explains how government-managed retirement systems across the developed world were structured in ways that guaranteed future shortfalls while presenting themselves as secure long-term savings programs. In the United States, the United Kingdom, and across much of Europe, workers have contributed to state pension systems for decades under the understanding that those funds would be preserved for retirement. Governments did not set the money aside. They spent it as received and replaced it with obligations to future taxpayers. The arrangement functions as a multi-generational transfer program, not a savings account. The structure holds as long as enough workers support each retiree. As populations age and birth rates decline, the ratio collapses. When that pressure arrives, governments adjust the system by raising the retirement age, reducing benefit calculations, or increasing contribution requirements. The promise changes. The terminology does not. The adjustment is called reform rather than reduction, but the outcome for recipients is identical. Principle 7. The quantitative easing that rescued asset owners first. The seventh principle demonstrates how the monetary policy response to the 2008 financial crisis created trillions of dollars in new wealth, distributed almost entirely to those who already owned assets, while increasing the cost burden for those who did not. Central banks in the United States, Europe, and the United Kingdom created trillions in new currency and used it to purchase government bonds and mortgage-backed securities. The stated purpose was to stabilize financial markets and prevent deeper economic contraction. Markets did stabilize. Asset prices rose dramatically. The S&P 500 tripled in value in the decade following 2008. Real estate prices in major cities climbed to historic levels. Bond prices increased. The families and investors who held those assets captured that appreciation. The majority of households that did not hold significant investment portfolios saw limited benefit. They experienced the side effects instead: rising rents, rising food prices, and the persistent erosion of purchasing power that follows large-scale currency creation. Principle 8. The complexity trap that hides the transfer in plain sight. The final principle reveals the mechanism that makes all the others sustainable: deliberate complexity. When ordinary people cannot understand how financial systems work, they cannot identify where their wealth is going or organize effectively against its extraction. Tax codes run to thousands of pages. Financial instruments require specialists to explain. Government budgets are published in language designed to obscure rather than clarify. Regulatory frameworks use terminology that shields the underlying beneficiaries from scrutiny. Ancient Rome debased its coins physically, requiring only that citizens not examine them too closely. Modern governments debase value through instruments that require graduate-level economics to trace. The lesson that connects every principle in this video is the same one that connects Rome to the present. The mechanism changes, the outcome does not. Wealth moves from the many to the few. The transfer is hidden in language the majority cannot pass. The remedy is the same across every era as well. Understand the history, question the headline, and build your financial position outside the systems designed to extract from you. If this breakdown of the 8 money tricks governments use to transfer wealth has given you insight on economic history and financial self-protection, share this with anyone who still believes rising prices are just bad luck and bailouts are acts of generosity. Hit the like button and subscribe for more insights that separate those who understand the system from those the system understands, the financially informed from the financially managed, and the protected from the extracted. You may also comment down below on which of these 8 tricks you believe has the largest impact on ordinary people today and why. See you in the next video.